morning and welcome to the Los Angeles World Affairs Council and Town Hall. I'm Kim McCleary, President and CEO, and it's my great pleasure to welcome you to today's program. We are so excited about bringing back our in-person events, beginning with an exclusive members-only tour of a new exhibit at the Skirball Center, July 15th. We also announced yesterday that we're providing our members with a free subscription to the Daily Chatter, an international newsletter written by top journalists around the world. So if you're interested in becoming a member, please consider joining us by visiting our website. For those of you who would like to ask our panelists questions today, there's a Q&A available for you to put your questions in on the right-hand side of your control panel. Jessica DeGanzik will be managing your questions during the Q&A portion of today's program, which will start in about 35 minutes. Besides our programs on national and international affairs, we are also pleased to present discussions on very timely topics affecting the world of business. Today, we will learn more about special purpose acquisition companies, or SPACs, which are among the fastest growing financial instruments in the world. We are delighted to present this program in partnership with KPMG LLP, a longtime corporate member. Today's program will feature a short presentation by Shari Mager, advisory partner at KPMG, followed by moderated discussion with Grant Heffernan, Vice President at KPMG, Corporate Finance's U.S. Technology Practice, and Pat Dillion, Chief Financial Officer at TuSimple, an autonomous delivery company. It's now my pleasure to introduce Michelle Wroan, who will moderate today's discussion. Michelle is managing partner of KPMG's Los Angeles office. She is also a World Affairs Council and Town Hall board member and officer. Hi, Michelle. We're so thrilled that you're moderating today.
Thanks, Kim. I'm happy to be here. Thanks for having us. We were excited. There's a lot going on right now, as you mentioned, in the SPAC world. It's quite a hot trend, and there's been a lot. It's been a roller coaster of a ride, lots of ups and downs. So even since we first started planning this event, a lot's changed in the environment. So we're excited to talk about that today. And I brought with me a couple of individuals from KPMG, as well as a CFO from TuSimple who recently went through an IPO process. So we're going to hear all kinds of perspectives around the SPAC process, but also around other alternatives. So
let me turn it over to you then. Thank you so much.
Okay, great. Thanks, Kim. All right, see ya. So we're going to, in our agenda today, as Kim mentioned, we're going to start with a discussion around what is a SPAC, what should you know about what's going on, what's the latest and greatest in the SPAC environment. There has been a lot of activity. And like I said, a roller coaster ride. So we're going to talk with Shari Mager. She's an advisory partner here at KPMG who's spending 100% of her time right now on SPAC activities. And then after Shari presents, we're going to then turn to a panel discussion with Shari, Grant, and Pat to talk about not just the SPAC market, but what are some of the other alternatives for liquidity and capital raise. And then we'll open up to the group for questions. So Shari, I'm going to turn it over to you now.
Great, thank you, Michelle, appreciate it. So thanks everyone for having me today. Looking forward to the discussion. So I thought I'd just start with, a few minutes of a bit of an introduction around, what is the SPAC and what is going on in the market and what is it, that would be useful for you to know. So if we could just advance to the first slide, please. So a SPAC actually stands for a special purpose acquisition company, and it's a way for private companies to go public through an acquisition. And so what happens is at the very beginning of the process, a SPAC will be formed by a sponsor and will raise money through an IPO. And the money gets put into a trust and is set aside. So the SPAC really has no activities, but its purpose is to go out and find a target and acquire that operating business and perform a business combination transaction. So when the SPAC goes public initially, it typically doesn't know what company it's going to acquire. It may have specified a specific industry focus, but many of them are also very general and, say they'll look at any and all industries, but they have a lifespan of approximately 2 years. So it's anywhere from around 15 to 24 months, but the more typical one is they have about a 2-year timeline to go out and find the operating company that they are going to acquire. And in that time frame, the money that was raised through the IPO by the public investors is just put in a trust and is put aside for that business combination. There's a small amount that they can use for transaction expenses, but for the most part, that money gets put aside and waits for the transaction to occur. And so the sponsor of a SPAC is a financial investor or an experienced entrepreneur, and that's part of the benefit of what they bring to the table is that experienced management team and leadership team that has potentially proven themselves in the market before. So you'll often see sponsors that do multiple SPACs, and they bring that experience to the marketplace. And it's taking essentially the M&A market, the private M&A markets, into the public domain. And what happens is, the sponsor raises what is called at-risk capital. And so they will, buy what typically is referred to as founder shares. And those are in addition to what the public investors put in. And what ultimately happens is typically by the time the transaction closes, they have what's called the promote, and they essentially end up owning 20% of the combined company once a transaction closes. And we call that a de-SPAC when the transaction closes. So that's kind of some of the high level around what a SPAC does and what it's looking to accomplish. If we could go to the next slide, please. So what's important to understand is sort of the structure, right? So there's going to be the SPAC, which is the piece I just walked through, and they're providing the equity for the transaction and liquidity. So they've raised funds from the public markets. They're going to go out and look for a target company. And there are all sorts of target companies that are attractive. Some SPACs are looking for companies that are more mature and technically could do an IPO of their own right if they wanted to. Other SPACs are looking for less mature companies that maybe don't even have any revenues yet today, but they're banking on the future potential. So it isn't unusual to see target companies, with no revenues, but with some, significant growth trajectories. And we've seen quite a few SPACs in the technology space. That's been the predominant industry that we've seen over the last couple of years. And, those companies tend to be of the type that, maybe are still in that high growth stage, have some revenues, maybe, net losses still, but have really either the niche benefit that they're bringing to the marketplace that isn't already out there, or some other element that the SPAC is looking to capitalize on. And so what happens is there will be, the process is the SPAC will identify the target they want to go after. They'll enter into what's called a letter of intent, and they'll start doing diligence on the target. And in return, the target will also perform diligence on the SPAC, because the interesting phenomenon that's going on right now is there are so many SPACs out in the marketplace that have gone public that are looking for targets, and there's a lot of demand for good quality targets out there. So the targets actually have some power in selecting a SPAC that they want to merge with, and they can really be judicious and honestly really negotiate the terms of the deal, just given the high demand, the number of SPACs that are out there, the amount of capital that's ready to be deployed, and the attractive targets that are out there. And so during that letter of intent phase, the parties are performing diligence on one another, and they're negotiating a merger agreement. And so one of the things that's a benefit of a SPAC transaction over an IPO is you essentially set the terms up front of the acquisition. So it's like a target company doing an IPO, but not waiting until the IPO goes effective to see where their stock price trades at. They can negotiate a lot of that upfront through the merger agreement. So there is some flexibility that gets built into the process. There's also, however, on the flip side, there tends to be more dilution for the owners of the operating company than what would typically occur in a traditional IPO scenario. Now, let's assume for a minute that the SPAC, because there's so much competition out there for targets, doesn't find a target in its 2-year window. So what happens in that case could be 2 different scenarios. Either the SPAC returns the cash to the public investors, so that money that was put into a trust gets returned, and essentially the SPAC, closes down and folds and doesn't continue to be. It lived its 2-year life and maybe didn't succeed in finding a target, and that's the end of its life cycle. There is also another option in that they could extend the life and renegotiate and have more time to go out and find a target. But ultimately, it does have to find a target and merge in order to continue on. And so, there's a couple of examples that we've listed on the slide, some names that you are probably familiar with. So often you won't have heard of the SPAC necessarily, or it could be, there's multiple SPACs from the same sponsor. So Hostess Brands is a name that you're probably familiar with, and Gores Holdings is the SPAC that acquired Hostess Brands. Similarly, Virgin Galactic was the target company, and the SPAC that acquired it was Social Capital Hedosophia. So there's lots of examples out there right now. This has been it's a phenomenon that comes and goes in waves. I think I worked on my first SPAC transaction about 10 years ago, and that was the Burger King acquisition by Justice Holdings, which was a UK SPAC. It comes and goes in favor, and it really does depend a little bit on the marketplace. And what has occurred in the last sort of 18 months to 2 years, there's been a big uptick and a resurgence in SPAC activity, and really more, I think, sophisticated sponsors and honestly, more mature targets that they've been looking at. And it's been a good way for the market to deploy its capital. But what you'll see, what I'll mention in a couple slides is, and Michelle alluded to it, is there's been, quite a significant turn in the market over the last, say, month and a half. But we'll touch on that in a little bit. But there are, you'll often hear that a SPAC transaction is a faster way to go public for a target company. I will tell you, I don't necessarily agree with that. What typically happens is an IPO company or a company that's looking to do a traditional IPO will often start planning and preparing early on. And so what might feel like, a long time to actually go through the process is because of this upfront work that they're doing to get ready to be public. In a SPAC scenario, the target company may be less far along in that process of getting ready. And once the transaction really kicks off, there's not a lot of time to focus on anything other than getting the deal done. And so what happens is some of that readiness ends up happening, in tandem with the transaction itself, but oftentimes after a transaction closes. And so it might feel like a SPAC transaction is faster, but that's because some of the readiness actually just gets deferred until later. But when we really think about from a merger agreement to a transaction going effective, compare that to in an IPO scenario, an organizational kickoff meeting where the process really starts with the bankers and all the advisors through to an IPO effectiveness. Those timeframes are pretty comparable. So I think, the real transaction timeline, at least in my mind, is still pretty similar between the two options, especially these days because the the volume is so high that the backlog going through the SEC has tended to slow things down a little bit from a comment process. So if we could go to the next slide, please. I just thought I'd walk through a simple example. So you'll see in slide, in box 1. So as I mentioned, there will be a sponsor, and they will put money into a new organization, a SPAC, and they'll take out their founder shares. And so that's kind of the first step, is they actually have to create the SPAC. And then the SPAC will go out and raise money, which is the second box. So at that point, you'll have not only the sponsor who's invested in the SPAC, but also the public shareholders. And the public shareholders, as I had mentioned, their money essentially gets set aside until the SPAC can go out and find a target company, which is the third box. So, separate from the SPAC, you've got this operating company that has its own shareholders that may be someone or something that the SPAC is looking at. So these are really the players at the outset before any type of a transaction starts to get negotiated. And so if we could go to the next slide. So then what happens is, I mentioned the letter of intent, the diligence is going on. Ultimately, a merger agreement gets negotiated and gets signed. Well, while that is going on, there is also a PIPE process that is underway, and that's actually going out into the marketplace and getting additional investment. Because typically the money that gets raised in the SPAC IPO, say it's 200 million, 300 million, isn't usually going to be enough to purchase the target company. Now, obviously, it depends on the valuation of the target company, but there is typically additional funding that is needed. And so while the SPAC is negotiating the merger agreement with the target, they are also going out into the marketplace to get additional investment. And that's, through a PIPE. And so these are now the parties. So, once we've lined up the merger agreement, once we've lined up the investment, there's going to be a process to file an S4 with the SEC and basically show what the combined company is going to look like. So this is essentially, although the SPAC has already done an IPO, this is essentially now how the operating company ends up doing its, I'll call it quote unquote IPO. It's going public through a SPAC. And the process is done, via an S4 registration statement or a proxy statement and filed with the SEC. So there's, just like in an IPO process, there's an initial filing that gets done. It's going to show both the historical information for the SPAC as well as for the operating company. And there will be pro formas that show how these two companies look merged together. And the SEC will review that and will provide commentary. There'll be, maybe a couple of rounds, 2 or 3 or 4 rounds of back and forth with the SEC, just like in a traditional IPO with an S1 process, until ultimately the SEC declares the S4 effective, and then there will be a shareholder vote on the transaction. And so this is where it, also can get a little bit interesting in that the public investors who invested in the SPAC, they have an opportunity at this stage to either vote for or against the merger. And they also have the opportunity to decide whether they want to get their money back or not that they had initially invested in the SPAC. So that's not the typical scenario, but it is, something that can occur. And that's therefore the importance of having, the additional funding, the PIPE investment, because you don't necessarily know how many of the public shareholders are going to want to stay into the deal, because they may not think it's a good deal for them. They may not think it's the company they want to be invested in. And so there are these interesting dynamics around a public shareholder could still vote for the transaction to go forward, but could still request their money back if, they don't see the upside potential. So there's, a lot of uncertainty that can occur around these transactions. And that's sort of the unique nature about it. But ultimately, ideally, the goal is obviously to find an attractive target that the public shareholders are interested in being invested in. And ideally, through a shareholder vote, the transaction closes, the deal is effective, and there would be an 8K filing with the SEC to basically announce that closed deal, and then life as a public company begins for the merged company. So if we could go to the next slide. And so what I wanted to do is just touch briefly on what we've seen in the marketplace, and the slide, hopefully the bar graphs give you a bit of a picture. So SPAC activity really started to pick up again in 2020, but 2021, we're only in June, early June, and 2021 has honestly blown away 2020. And really all of that happened in the first quarter. So we've had 330 SPACs to date in fiscal year 2021. So those are the SPAC IPOs that have been, the SPACs that have been created and that have done an IPO. And they've raised 105 billion in capital, to date so far this year. So if you think about, we've had the same, or more number of SPACs in 3 months of 2021 as we did in all of 2020. That gives you a sense of the volume of activity that has, just been honestly crazy this year, and has kept me very busy and has been very interesting, definitely as well. The other circle there on the slide, the actions announced. So those are the merger agreements that have been announced. So once the SPAC has found its target and negotiated, it becomes publicly known. So you don't really know who the SPAC is going after until that merger agreement is signed and publicly announced, and that's really when the SEC process begins. So there have been 150 announcements of potential transactions so far this year. And what that also means is we still have 422 SPACs that are looking for targets and that haven't, announced a deal and are out there competing for rich targets. And so the other thing that is actually not on here is showing which, how many deals have closed. I think I have that on the next slide. So if we maybe want to go there. Yeah, so there have been 39 transactions that have closed so far this year. So I think, the thing that's interesting about the SPAC, as I mentioned, the first 3 months of the year were extremely high volume. We've had a significant drop off in the months of, well, certainly the month of April. May started to pick up again, but certainly a slowdown compared to the first 3 months of the year. And I think, as I mentioned, the technology industry has been the industry that's had the most activity, but you'll see, a multitude of industries have been impacted, by the SPAC activity. Healthcare certainly as well is another one that's seeing significant opportunity, especially, that's an area where typically it might be, they might be pre-revenue companies, and really what the SPAC and the SPAC sponsor and the public investors are banking on is, that future potential that, might be waiting on an FDA approval or something of the like. So it's certainly been an interesting and dynamic environment. It's really combining the elements of a traditional IPO with an M&A transaction. And so, it is a merger. It's a SPAC merging with a target company. So it is certainly drawing from the M&A aspect there, but the target company is going public through the SPAC, and so it's also got elements of an IPO. And even though the market has cooled in April and May so far this year, we actually do think that this is now probably going to continue as maybe a more prevalent scenario than what has been, say, in the last 5 years prior to 2020. And it really just gives alternatives to companies as it's a vehicle for going public. So I think traditional IPOs are going to continue. SPACs, is another avenue. We hear a fair amount, these days also about direct listings, which is another opportunity for companies to go public if they're going to just sell, secondary shares and not do an initial offering. And M&A continues to be strong. So, we used to talk about dual tracking And that's when companies would do an IPO or look to do an IPO as well as an M&A transaction. Well, now we're talking about quad tracking. So there's a lot of optionality in the system and ways for companies to go public. So if we could go to the next slide. What I've summarized on here is just, some of the current market conditions. And, it certainly sets the stage, I think, to show that things are changing from what we were seeing in 2020 and early in 2021. And some of it is driven based on regulatory scrutiny. So one of the things that happened in the middle of April is the SEC came out with some statements around a couple of key areas. So they focused in on warrants and the accounting for warrants. And warrants are a significant piece of the equity instruments that are given in a SPAC transaction. So one of the things I didn't mention is when the public investors initially buy into the SPAC, not only are they buying shares, but there are also warrants that are given in conjunction with the shares. And so even if the investor chose to take their money out of the SPAC and redeem their shares, they might still hold on to the warrants, and the warrants have the option of accruing in value as well. And so warrants are a very typical equity instrument that are given to the sponsors, to the public shareholders, to the PIPE investors. And there's been, quite a bit of change in the marketplace around how these instruments are accounted for. And they used to be accounted for as equity, but when the SEC started to really look into the terms of the arrangements, there are a couple of key clauses that really prompted the warrants to be to be liability classified. And what that does is it causes a requirement for the SPACs and the de-SPACs to essentially mark to market the liabilities every reporting period. And so there's a fair value exercise that needs to happen. And so none of that changes the economics of a SPAC transaction, but it changed, the accounting and certainly caused a slowdown through the SEC because it caused a lot of restatements of both SPACs and de-SPACs. And just the volume that had to kind of go through the SEC, especially it became quite impactful in the May timeframe because there were restatements of 10Ks that were going on, and there were 10Qs that needed to be filed for the first quarter, and all of that was happening at the same time. So we definitely saw a slowdown, caused in part by the SEC. And then secondly, the SEC is also focused on projections. So one of the key differences between a traditional IPO and a SPAC merger is that in an IPO, companies cannot put forward-looking projections into the S1. But in an S4 and in a merger, it's actually a requirement to disclose projections. And so just the level of diligence that was being done around the projections is something that the SEC is also focused on. So if you think about when companies put out projections and they're trying to get the PIPE investment, people are investing based on those projections. And then the de-SPAC company is really held accountable to those projections on a go-forward basis after the merger closes. And so there's been this view from the SEC that there needs to be more rigor and more diligence, put around those projections. So I expect we'll still see more to come around that topic. But those two things have sort of impacted the process. And then just generally in the market environment, the gains that the de-SPAC companies have experienced after the close of the transaction have started to stabilize and even come down. And so you'll see some stats here around the number of SPACs that are missing, or de-SPACs that are missing their revenue projections, or that the stock price is falling below what it was trading at sort of in the initial de-SPAC transaction. So just sort of there's some economics around the environment that are causing some slowdown and really just a bit of a pause. And so I think there's going to be a little bit of a wait and see as to what happens in the remainder of the year. So Q1 was hot and heavy. Q2 has experienced a fairly significant slowdown and is starting to come back. And so to be seen what's going to happen in the remainder of the year. But nonetheless, it's exciting times in this environment, and it'll be interesting, I think, for all of us to see how it evolves. So if we could go to the next slide, please. So I touched on this a little bit, and companies are certainly, if their goal is to go public and to access the capital markets, there's certainly a thought process to go through around weighing a SPAC transaction versus a traditional IPO. And I think I touched on some of the benefits and some of the downsides, and it really depends on sort of speed to market that companies are interested in, the amount of capital they're looking to raise, whether they want to tap into the sponsor to get some, expertise from the SPAC that, maybe they don't have in-house or can't, access outside of the organization. And it also is, what amount of control do the founders of the target company, what amount of control are they willing to give up and comfortable giving up? Because there will be, a lack of a decrease to the amount of control they have, as well as, there will be additional dilution. So there's, the pros and cons to be weighed. It is pretty typical for companies to start off going down, maybe both of these paths. And as I mentioned, not just dual track, but some are, triple tracking and quad tracking. But you can't, I think the downside of that, it creates optionality and flexibility, but it also creates distraction. And so there is a point in time where I think it's important to make a decision on which track the company is really serious about, because there's only so many hours in the day, so many people on the, the company's management team, that to have them trying to focus on too many paths at once really will actually delay the process and create distraction. And there's also an element of, once you start talking to the pipe investors, if you're pursuing a SPAC transaction, it makes it really, I think, not possible to do an IPO just from a sense of, the information that's been disclosed to the investors. So there does come a point in time where you have to actually pick, the one process that you're going to pursue. But, I think we'll talk about that on the panel of, the different paths that can be taken and more about the advantages and disadvantages. But I think the good news is that there is a lot of optionality out there in the marketplace for companies that are interested in going public, and it's exciting times for them. And then just to the final slide, I think. Perfect. Yeah, and so I think, this summarizes, I think, some of the points that I mentioned around advantages and disadvantages. And, I think we'll probably hear more from the panel, especially with Pat, who's been through the IPO process. Certainly will be interesting to hear some of what, experienced. And I think, Michelle, I will plan to turn it back over to you, and we can actually start the moderated discussion.
All right, great. So if Grant and Pat want to come on screen as well, we'll get started with our discussion. All right, there they are. Okay, thanks, guys. So let me just start off first. Grant, maybe I'll start with you, because we've been hearing from Shari just regarding what is a SPAC IPO transaction, all of the differences really. But can you describe or explain kind of what you're seeing in terms of some other common exit, liquidity, capital raise options for companies? What else you're seeing? I mean, we've been talking that there's so much of the SPAC activity going on, but I think it's overshadowing some of the other activity that's out there and other options for companies.
Yeah, absolutely. So I kind of bucket things into three main categories. The first one's your traditional sale, merger and acquisition. That kind of breaks down to two main categories, either a full outright sale, which typically happens with a strategic buyer, or a majority recapitalization, meaning the founders or the shareholders sell roughly anywhere from 50 to 75% of the company. This could be to a private equity sponsor, potentially a private equity portfolio company, But the key thing to realize on the latter one is that 25% is typically rolled over, which gives the shareholders the opportunity of a second bite at the apple. The second bucket I would classify as the minority investment, i.e. a less than 50% investment in the company. Typically, this is mostly primary capital, meaning capital that goes to the balance sheet. But what we're commonly seeing nowadays with the competitiveness in the markets is investors are willing to basically purchase more secondary shares. So as an example, maybe a $100 million investment by X, Y, and Z growth equity shop, and roughly 70 million of that will be primary to the balance sheet, but the other 30 million or so will be secondary to the existing shareholders so they can get some liquidity. Like I said, historically, it's been predominantly 95% primary, but we're seeing that amount of secondary actually increase substantially as markets get more competitive. And then last but not least, but Shari touched on this, is the traditional IPO. I think one thing I would mention is that compared to the stock early 2000s, where you saw folks like Pets.com go public with, $1 million of revenue and negative gross margin, I would say the bar to go public through the traditional IPO route is pretty high. I think part of that's driven by the fact that there's $2 trillion of dry powder private equity and venture capital on the sidelines. And I think that's really driving companies to be, especially in the technology sector where I work, to continue executing on their plan in the private markets and not be exposed to the volatility of kind of the broader public markets. So those are kind of three buckets I'm seeing at this point.
Okay. Yeah, no, thanks. And that's actually a really good segue to Pat, because Pat, as our representative CFO on the panel, and thanks again for joining us, TuSimple, your company, recently just completed an IPO on the NASDAQ. Congratulations. In going through the process, did the company consider a SPAC IPO process or other capital raise options, or had you just gone down the path of traditional IPO? Maybe you can tell us a little bit about the company's thinking.
Sure, and thanks for having me. So as we thought about the different options to go public back in the summer of 2020, we did consider a SPAC. It was a relatively new phenomenon at that point in time that a lot of technology companies that fit our general profile of sort of pre-revenue or low revenue, focused on large-scale disruptive technologies, were going public through a SPAC. But ultimately, we decided to go down the traditional IPO path. When you think about what a SPAC can deliver to a company like ours, there are a number of potential advantages and reasons why you would go through there. The first is the credibility and diligence of the actual members of the SPAC to be able to vouch for the technology and the business model of the target company. The second part, which follows on closely to that first point, is that many times the members of the SPAC will become board members or play some type of other governance role in the combined company post-transaction. Another point is that by going through a SPAC process, you can put forward-looking projections out there, which allows you to talk much more about the future as opposed to the past. And in a company like TuSimple, where in 2020 we had about $2 million of revenue, and we currently trade at a market capitalization of about $8 billion, the past financial results are not necessarily telling the entire story about what the economic opportunity and what the investment thesis is. So for us, ultimately what it came down to is we felt like from both a diligence and a governance perspective, we could solve that in different ways. We have added 2 very strong independent board members, and that was important for all of our IPO investors. One, Brad Buss, who was the first outside director at Tesla and has held many directorships and operating roles within the technology world over the last 30 years. And Karen Francis, who has lots of experience both in the automotive and technology world, including serving as the chairwoman of Vontier, which is a publicly traded industrial technology company. So we added 2 really strong directors, which helped us sort of address some of these issues around both governance as well as diligence. In terms of being able to put out projections, yes, there is a limitation in the IPO. You won't see forward-looking projections anywhere in the prospectus or any of the public-facing materials. But with a traditional IPO, there is a longer process of engagement with equity research analysts prior to actually going out on the road. And by engaging with roughly a dozen banks that had equity, that were part of our IPO syndicate, and their equity research analysts across a variety of different disciplines, people from the technology world, from the automotive world, from the freight transportation world, and explaining our business model and providing to them some forward-looking projections, which they then used as an input to develop their own forward-looking projections for TuSimple, which you can see now manifested in the research reports which they have published on us since we've gone public. That's actually a way for us to tell the story, but actually have it be vetted by people that are very knowledgeable in the space. And we felt like that was actually a better mechanism to be able to give forward-looking guidance to someone else, have them vet it, credible folks that are used to dealing with investors like the equity research community. We actually felt like that was a better mechanism and a credible mechanism for us to talk about forward-looking guidance. The last part, and really what it comes down to, is when you think about the difference between an IPO and a SPAC transaction, they are very similar. They are just different ways of going public. For us, with a technology which isn't well understood, being the first autonomous vehicles company to go public, we felt like it was very important to show up for our IPO roadshow with a fully vetted SEC document in hand. And that's a little bit different in the order in which it happens versus a SPAC transaction, where you don't have a fully vetted SEC document when you're out raising the pipe and approaching institutional investors. On the IPO roadshow, you could actually see a prospectus. It had been publicly filed for anyone who wanted to tear through it. That prospectus had been through multiple sets of counsel comments, as well as multiple rounds of SEC comments. So we felt like just getting everything out into the open, so there was no mystery about what we were not, what stage of development we were in, was really important, because I think there was a lot of misunderstanding or potential assumptions about what we were doing or what we were not doing. And it was great to just get that all out into the open before we approached investors.
Great, thanks. No, that's really helpful to hear the thought process that you went through, and at the same time pointing out the kind of the pros and cons of both. Shari, we talked about, or you addressed already, just the recent slowdown that we've been seeing, prompted by some of the SEC's comments and questions. However, we still see SPAC IPOs as a viable opportunity continuing beyond just this craze. Do you think that there will be more of a balance between the traditional IPOs and SPAC IPOs go forward, or is there a new trend that's coming around the corner that we should be aware of? Grant touched on a couple options, but what do you see, or do you have a sense as to where you think things might be headed?
I wish I had a crystal ball. I do think, I think SPACs are probably going to be more prevalent sort of on a go forward basis than maybe we've seen in, the last, say, 5-10 years. I think they've shown that they can be a viable option for companies and good quality companies. And so I think, probably more balance between IPOs and SPACs is something to see in the future. But that's not to say that there's not going to continue to be a number of private M&A transactions. That is predominantly where the activity occurs. And I actually heard an interesting comment from a banker a few weeks back, and I thought it was, kind of an interesting way to put it, is that, venture capital firms and private equity firms, they're placing bets in a number of companies, and many of them don't succeed for them. But if they, bet on 10 and 1 or 2 of them are successful, those can end up being good economics for them. Well, that has now kind of translated into happening in the public market. So it'll be interesting to see how the de-SPAC transactions, if they, continue to be successful, or if we're going to see, you know, some of them fail because we've taken what used to happen in the private markets and, you know, put it into the public market. So I think that's a dynamic that is yet to be seen, because this wave, you know, that we've had in the last 6 months, we don't have the track record yet of, you know, how the de-SPAC transactions are going. So I think that's something to keep an eye out for. But, you know, I think with IPOs, SPACs, direct listings, M&A, there's still a lot of options for companies to have exits, and I think we're going to continue to see all of these going forward.
It's a lot of opportunities. Grant, this slightly different topic, but related. How would you compare what we're seeing in the capital markets right now and the ability to raise capital, regardless of method, as compared to what the environment was before the pandemic?
Yeah. I mean, I think the thing that we're telling our clients is surprisingly, there's no better time to raise capital or gain liquidity than now. I think all of us, when COVID hit last year in March, I think all of us would have taken the under on that bet, but I think it's just driven by a variety of things. I think the first of all, as I mentioned earlier, it's the dry powder available. $2 trillion of dry powder capital on the sidelines, and these managers only get paid if they deploy that capital. So they're highly incentivized to deploy that capital in any which way possible, whether that be a majority recap, sale, secondary. And we're seeing a lot of really interesting kind of models and investment structures for that exact reason. I think the other thing is we are seeing behemoth funds being raised. Funds that may have raised $1 billion, $2 billion fund 8 years ago are raising $10 to $12 billion funds. So we're seeing enormous amounts of platform companies being built where additional capital is being deployed to do bolt-on transactions. For reference, last year, 68% of private equity capital deployed was for bolt-on deals. So we're seeing a lot of activity from that perspective. And I think the other really important point, as we all have seen, is the lower interest rate environment. We're seeing leverage ratios that are, I would call, pretty frothy. Historically, 2 to 3 times EBITDA leverage ratios. We're seeing companies getting levered at 7 to 10 times, which is remarkably high. I mean, I think in short, the key takeaway we tell our clients is raise capital when you can, not when you need it. Because, for lack of a better phrase, when it turns, it becomes really, really difficult to raise capital or sell, and the leverage kind of shifts to the investors. Might as well take advantage of it while it's a seller's market to raise capital or gain liquidity.
Yep. Okay. I'll end with this last question for Pat, and then we'll open up to the group for the audience here for any questions, and they can submit through chat. Pat, so kind of following along that point, TuSimple completed their IPO right in the middle of the pandemic. From your perspective, was that a hindrance to the process, or was it a help for a lot of these reasons that Grant's explaining in terms of access to fundraising?
I think in some ways I agree with the points that Grant made. I think from a practical perspective, for a company like ours, where it is a technology that really is best experienced live, where people can come and take a ride in our autonomous truck and see how it can navigate surface streets and highways fully autonomously. The pandemic was certainly a hindrance for us, because our hit rate on investors that came and rode in the truck prior to the IPO and then later invested in the IPO was 100%. But with COVID and travel restrictions, that was very difficult. But in terms of the efficiency of doing meetings on Zoom and being able to get 10 or 12 or 14 meetings a day, it's certainly a lot easier than, trudging through Los Angeles or Midtown Manhattan and going from meeting to meeting. But I think the overall environment in terms of people having capital to work, to put to work, was certainly constructive. And I think we have seen, just largely speaking, in our neck of the woods, in kind of transformational technologies, particularly around mobility and logistics, there has been the sea change where types of companies like ours are no longer viewed as science experiments, and there is this huge momentum around transforming the transportation sector, whether it be around alternative propulsion technology, alternative fuels, autonomous operation, more digitization. And so I think the investor community has realized that, has realized there's a wave that's coming. And really it's become a question of we will need to invest in these spaces. Which company should we invest in, and at what stage of development should we be investing in these companies? And so I think the pandemic, for reasons that are, I think for multiple reasons, the pandemic has sort of accelerated a lot of those trends, at least, and accelerated investors' conviction around those trends as well.
Yep, that's great. Thank you. So with that, we have about a little bit less than 10 minutes left for questions from the audience. So I believe Jessica is going to moderate those for us, or at least let us know what they are, and I can help point the right person.
Perfect. Thank you so much. The first question, Wall Street professionals from high-profile CEOs like Richard Branson and fellow billionaire Tilman Fertitta have jumped on this trend and formed their own SPACs. The SEC worries that retail investors aren't adequately protected. Who set up the rules for SPACs, and could there be legal issues in the future?
Shari and Grant can probably weigh in on that.
I don't know who set up the rules for SPACs at the outset. I mean, certainly the SEC is governing a lot of the rules around the reporting and the process of going public. But I think certainly, you know, the protection of the investors is definitely what the SEC has been focused on. And it is, you know, it is their role, right? And that's why there's so much scrutiny going on, because there's just been such a wave of volume that I think, you know, the SEC has decided it might be prudent to, you know, slow things down a little bit and just make sure that we are protecting the investors, because I think the last thing anybody wants is, you know, multiple failures in the capital market. So I think definitely the SEC has had a role of playing, you know, oversight and governance on the process, which I'm sure frustrates some investors, but in the grand scheme of things, probably protects many folks as well. And sorry, there was a second part to the question, if you could remind me what it was.
Oh, I'm sorry, and I deleted the question because it was a long question. So just basically how people can be protected. You know, what protections, are there going to be any issues in the future?
Oh yeah, issues in the future was what I was thinking of. Yeah, I mean, certainly everyone needs to do their own diligence. It's no different, you know, if you're going to invest in something, you've got to understand the risk that you're undertaking and be comfortable with that risk. So, you know, everyone's kind of like buyer beware. I think everyone has their responsibilities to, you know, do their diligence. The SEC is playing a role in that. Certainly, the council, you know, is doing the same, as well as the investment advisors that are involved. So I think, you know, there's a number of folks that have responsibility around making sure this is a robust process. I do think, as far as, you know, risks in the future, so I'm not an attorney, but I've certainly been on the sidelines and have seen there has been an uptick in lawsuits around, you know, SPAC transactions. And so that is something we may see more of here in the future as things sort of balance out and the volume maybe comes down a little bit and more mature companies, you know, make their way through the process. So I don't know, Grant or Pat, if you have anything to add to that, but those are certainly some things that I have seen and that are probably yet to come.
I might just have you answer that one, and then we'll move on since we are running out of time. This next questioner says, as an experienced startup investor with a robust measure of success, I've noticed the great difficulty there is for minority startup capital. Is this route a viable path for them to pursue? So for minority business owners, is this an opportunity that they could pursue?
Yep. Grant or Shari could weigh in.
Yeah, I think there definitely are. I mean, I think there are. I think over the past year with the, you know, events we've seen, I think there's a greater focus from basically private equity and venture capital community to invest in minority-owned businesses and things like that. I think having a more kind of holistic approach to their portfolio versus just making it all about the numbers, I think is becoming increasingly important. I think so. Yeah, I mean, I think it's definitely increasingly becoming something that funds are looking at, and also differentiating, because I think as a, you know, a founder-owned company, minority or not minority, they want to partner with a firm that has that perspective of, hey, we're going to support these minority-owned businesses. So I definitely think there's a lot of wood to chop there, but I think we're at least moving in the right direction.
Thank you. On average, what is the difference in price paid by the initial SPAC public shareholders and the PIPE investors?
So the initial investment by the founders in the SPAC varies, and it can be as little as $25,000. Typically, SPAC shares are offered at $10 a share. That's a pretty standard price. So that's typically what the PIPE investors are going to buy in at, is at $10 a share. Now, the amount that the founders put in varies, and certainly what they get when they get their 20% also varies pretty significantly based on the ultimate enterprise value of the company.
Great, thank you. What are the risks that an investor should consider in deciding whether to invest in a SPAC?
Grant, do you want to take that one?
Yeah, I mean, I think, consistent with what Shari said a few questions ago, I think there is a increased level of diligence with some of these companies. I think it's kind of a double-edged sword, because the beauty of SPAC is sometimes as a retail investor, you get access to investors that you would never otherwise have access to. For example, Thoma Bravo, probably if not the best software investor globally. Historically, their funds have only been available to pension funds, but they launched a SPAC, they acquired this company IronSource, and retail investors have access to them. That is a management team and a board that I personally will bet on all day. It's just, they have amazing track record. So I think in that instance, you still have to diligence, but they have a really strong track record. On the flip side, there may be potentially less well-known funds or less well-known technologies that you really have to diligence. So I think taking, forecasts at the end of the day are forecasts, right? And we've all seen the hockey stick growth with all these companies, and I don't know, 7 out of 10 times they probably don't happen. So I think as a retail investor, you really need to heavily scrutinize what you're investing in, the market opportunity, and really the growth. I think it's a level of diligence that, it's really critical in these processes.
Thank you. A newsletter writer suggests SPACs are ways to get stock in new companies, just like pre-public investors in terms of returns. Is this true?
Yeah, I mean, I think it's giving investors access to, buy-in at an earlier stage than maybe when that company would have traditionally gone public, or when they would have had access from a private perspective. And I mean, that's what the SPAC is banking on, right? Is the growth trajectory and the potential increase in value by getting in early. And so the investors that get in, into the SPAC IPO are going to benefit from that as well.
What are the issuance and offering expenses typically fronted by the SPAC sponsors and founders as a % of the SPAC IPO?
That's a good question. I don't know the percentages. I don't know, Grant, if you do.
Yeah, I think it really varies case by case. I think sometimes it's, 10%, but yeah, I think it's really hard to pin down. It's really case by case.
Yeah, but it is a relatively small percentage, because I think there are requirements around, there's only a minimum amount that can be spent on transaction expenses, and the bulk of it needs to be put in the trust for the actual merger transaction.
Thank you. Why did SPAC activity slow in the second quarter of 2021? Interest rate risk for debt from PIPE?
Well, I think there were a few factors that caused the slowdown. As I mentioned, the regulatory scrutiny, I think, was probably the predominant reason, because just fewer deals could get done. Basically, the SEC put a halt on new SPAC IPOs and de-SPAC transactions. So that certainly had a very big impact. But I think certainly market dynamics, there were decreases in how well the de-SPAC transactions had done, how SPAC stock prices were trading. So certainly probably influenced by, interest rate risk as well as other economic factors. So I think there was kind of like this convergence of a number of factors that all hit in sort of the April-May timeframe.
Perfect, thank you. Final question to Pat. Could you please tell us what TuSimple does and where you operate?
Right. I guess that's a good basic question. Maybe I should have talked about that.
Yeah.
So TuSimple is a company based in San Diego. It's an artificial intelligence company at the core of it. We're focused entirely on autonomous semi-trucks. So we are on the 5 levels of autonomy. We're focused on level 4 autonomy, which means that you can take a driver out of the cab of a semi-truck and operate along mapped routes. So think about it from one industrial park to another, areas that are typically located close to a highway, but not right on a highway. And being able to make semi-trucks, which move basically all of the goods that are in your home or your office, make them safer with 90% of accidents caused by human error, more efficient, and more environmentally friendly, in that our virtual driver technology is easier on the accelerator and easier on the brakes. So we've been able to show that we can actually reduce emissions by 10%. So we're at a stage right now where we're doing testing and development. We have a fleet of 50 trucks that are operating from Arizona all the way into Texas, operating along the I-10 corridor primarily. We operate with a safety driver that is ready to take over in the event that the autonomous system is not prepared to handle a particular driving scenario. We do have partnerships with 2 of the 5 largest semi-truck OEMs in the world, Navistar in North America and Traton Group, which is the publicly listed arm of Volkswagen in Europe. And we expect to start delivering and scaling our business in 2024. So we hope by the middle part of this decade, if you're taking a road trip, you will see our trucks hauling freight all along interstates across the southern half of the United States, and making the entire freight ecosystem safer, more efficient, and more environmentally friendly.
Awesome, thank you so much. And a lot of our audience was asking if they could catch this afterwards. So we will be uploading this to our YouTube channel. And for those that have registered, you will get a follow-up email that will include a link to today's discussion, which will include Shari's presentation. So thank you all so much. Michelle, I'm going to turn this back over to you.
All right. Well, thanks for joining us today, everyone. We appreciate it. And reach out to us via LinkedIn, and you'll have access to the YouTube playback as well. Thanks all. Thanks, Shari, Pat, Grant.
Thanks, everybody.
Bye.
Thank you all for your expertise and time. This was so fascinating. So I want to watch this again too and better educate myself on this great information. So thank you so all very much for joining us today.
Thanks, Kim.